joining us today for an exclusive interview. The famed short seller Jim Chanos is here to discuss the markets and what stocks he continues to bet against and why. Our investment committee is here too. Josh Brown, Jim Leventhal, Jenny Harrington is the CEO and portfolio manager at Gilman Hill Asset Management. Rob Sechin is with UBS Private Wealth Management, also one of Forbes' top 100 financial advisors. We do want to check where stocks are at this very moment in what has been a volatile few hours of trading. The Dow right now holding on to a 1.5% gain. That's better than 300 points. That's stunning claims number today. Everybody digesting that, of course. And then the stunning move higher in oil as well, on the president saying there could be a cut of 10 million barrels. Our Joe Kernan reporting that first. Let's welcome in Jim Chanos, though. He joins us today on the phone. Jim, welcome back. I hope you and yours are safe and healthy.
We are, Scott, and I hope the same for everybody there and everybody's family.
Yeah, we appreciate that. Can you first just sort of help us? I want to make sure our viewers understand exactly the angle that we're coming from today. What is your current positioning in the market? Are you net short as we speak?
Well, Scott, if you remember, we run basically two different types of pools of capital. We have the short only, which basically we've been doing since 1985 for clients that use us as a hedge, and then we have our own hedge fund, which basically is basically always net long, but to varying degrees. Right now, that is about 50%, give or take a little bit, net long, and that's on the low end of where it's been. We de-risked on the long side there back in late February, early March, and that's probably where we're going to be for a while. And then on the short onlys, it's been hard to stay short. Obviously, in my world, in that world, if the market goes your way, you get less invested. And of course, conversely, if it goes against you, you get more invested. So you're constantly dynamically having to change that. And depending on the client, we have managed accounts where the client's asking us to stay 100%. And then in the funds we have discretion in, we're probably around 75%. And that's basically, kind of in line historically. So that's where we are. And it's been a crazy ride, obviously, as your viewers know.
Yeah, for sure. And it's interesting that you say it's hard to stay short. I'm wondering your general view today of where this market goes from here, whether you think that we could retest the lows, if not go lower, or if you think we have put in a bottom in some respects, or we're close to doing that.
Simple answer. I have no idea. So basically what we're telling clients is for them, we're looking backwards and forwards, I think is the simplest way to describe it. We're looking for ideas that were silly based on 2019, and since everybody's going to write off 2020, arguably justifiably so, how do these things look? How do companies look coming out of this? And are questionable companies with questionable business models still priced at a premium today based on 2021? And, surprisingly, there's still lots and lots of situations like that, where companies are just structurally unprofitable. They're not going to they didn't make money in 2019. They're certainly going to lose a lot of money in 2020, and they're not going to make money in 2021. And I think those are the stocks your viewers should avoid, and those are the kinds of things that we're short.
Have you covered shorts? As you say, it is hard to stay short because of the big downdraft that we've seen in the market?
Well, you and I had a discussion. Sometimes it's better to be lucky than good, and we covered our energy shorts at the beginning of this week. And just because they were down an awful lot, if you remember from Delivering Alpha, I gave a talk back in 2017 about the frackers. And just pointed out that we've been telling clients for a long, long time that model was uneconomic. It was uneconomic at $25 oil, it was uneconomic at $50 oil, and it was uneconomic at $70 oil. And that's, those birds have come home to roost. Having said all that, a lot of our energy shorts were just decimated. And, the risk reward has changed like anything else in the market. And so, in individual situations, obviously we are being selective, and if the stock it really takes a dive for some reason, either anticipated or unanticipated, we'll get out. And it's one of the few things that short sellers do in bear markets that people forget about. We're often buyers on weakness. And Luckin Coffee was a good example today, which we were short thanks to Muddy Waters, who urged me to take a look at it back in February. Company comes out, stock is killed. The risk-reward dynamic obviously has changed. Time to move on.
So you covered your short fully on Luckin Coffee as the stock, as we're looking at it right now, is down more than 70%, Jim.
Yeah, we did. We did it pre-open this morning, and Luckin's a great example of when people talk about banning short selling or restricting short selling. This stock was being talked about by the fundamental short sellers and the community in January and February as a fraud. And it's one of the things that short sellers do. They're the real-time financial detectives in situations like this. And when you restrict that ability, you take away important actors in the marketplace.
I'm wondering then how you would respond to, and we're in a crisis, obviously,
Yep.
right?
Yep.
We all recognize that.
Yep.
To those who suggest that shorting stocks, and let me make a differentiation here. I'm not really referring to shorts that you had on for a very long period of time, well before the winds of the virus started to blow and started to change and come in a very big way. But what do you say to those who would suggest that now that we have what you could consider to be a quote unquote forced recession, if you will, and that shorting stocks or maybe initiating new shorts now is not the right thing to do? How would you respond to that sort of criticism? And I'm not suggesting that you are at the current time looking for more targets or not. You can tell me that, of course, but just the general perception of short sellers in the environment in which we currently live.
Well, Scott, I guess I would flip that around and say, when times are booming and people are promoting stocks left, right, and center, and investors are speculating on margin and often urged to do so, whatever the venue might be, whether it be TV or print or whatever, I would argue that far more financial damage is done to investors by that behavior than any behavior might be by fundamental short sellers who, by and large, in an environment like today, are net purchasers of stocks. And so we were selling stocks to those people who were probably doing things they shouldn't be doing with their capital in late 2019, early 2020. And now we're buying back stocks. We're a cushion to the market. So you have to be a little careful on that, in that I suspect that far more damage is done to your viewers and investors at large by behavior that probably should be checked in time of excess than anything, as I said, short sellers are doing in 2020.
And I certainly don't want to speak for you. Are you looking currently for more opportunities on the short side, or is because the market has come down so much, you're a little gun shy to do that at this point?
Well, I mean, obviously, valuations are lower. So we're always looking for opportunities. That's what we do. I don't know where the market's going. That's long been our view as a company, and as my view as a chief investment officer. I don't know where the market is going. I don't know that other people know where the stock market's going. What we do try to do is analyze companies, and we've been fairly successful in doing that. And so the idea is every idea stands on its own merits. Valuation is an important part of that. So if valuations are down, then we'll be less likely to do something. Having said that, as I said at the outset of our conversation, there's lots of situations where the valuations are still excessive and kind of shockingly so. So I mean, it's interesting. Now, there's lots of things that look interestingly cheap. One area I would warn people about, for example, is the virus stocks. I mean, there's tons of companies and I hear about them every day, on your network and other places about you should be buying XYZ because it's doing well right now in this enforced lockdown. So a lot of these companies that really are not structurally growth stocks are trading at 30, 40, 50 times earnings. because they're going to do well in the first and second quarters of 2020. But of course, when the virus subsides, as we all know it will, those companies will probably, begin to not look as attractive going forward. So that would be an area I think that I would tell your viewers to be very, very careful of, just piling into things that are doing well because people are inside and will stay inside for the next 3 or 4 or 5 weeks or 3 or 4 or 5 months.
I mean, are you suggesting, when you say virus stocks, just to make sure we're all on the same page here, the Zoom medias, the teledocs, things that have seen a big run-up?
The Pelotons, the Zooms, the Cloroxes. I mean, I could give you a list of 30 names, and I have a list of 30 names. I'm saying that a lot of companies are contra-cyclical right now because of the virus. And again, what we really would urge investors to do is look at the business and look at 2019 and take an educated guess and do your research and do your work on what you think this looks like in 2021. And if it's still a cheap stock then it might be an attractive investment on the long side. But if it's really, really expensive based on 2019 and 2021, you might want to think twice.
Are you short Zoom Media, for example?
We are not.
What about Teledoc?
Nope. I wouldn't do that to Josh.
We'll get to Josh in just a minute. I'm just wondering, just picking up on our conversation too, it's interesting that you talk about, analyzing stocks. That's obviously what you do for a living. This environment is incredibly difficult to analyze anything.
Yeah, because you have to write off 2020. I mean, again, I think and I think the market is and will ultimately. But you also have to be very careful because 2020 is going to expose a lot of business models. For example, look at the restaurant industry, which we have been short and remain short. I've talked about some of these stocks on your show and elsewhere on CNBC. I mean, what people got really wrong here was they looked at the restaurant companies, which are basically franchisors, and they said these companies are asset light. And therefore, they just collect coupons in the form of royalty fees. But what they missed was their franchisees were really, really leveraged, the people operating the boxes, and struggling before the virus hit. There were a number of Chapter 11s in the restaurant industry in December, January, and February. And on top of that, the franchisors, the guys like Dunkin' and Wendy's and restaurant brands, all are landlords as well. So they lease restaurants from investors and then sublease them to their restaurant franchisees. So there's sort of double hidden leverage there. And then on top of that, most of those companies then went out and bought lots of stock back at the highs. And so you've got companies that are really, really levered that are basically now the landlords for really, really levered restaurants underneath them who are also leveraged and losing money and or closing. So it's like triple leverage. And those business models, I think, are going to be exposed in 2020 for what they really are. And I think it's going to be one of the dark sides of the buyback boom, I think.
So names like Wendy's, Dunkin', and QSR restaurant brands, which you had said prior that you were short, you still are, all three?
We still are, yeah. We still are short all three names.
And more stocks in the restaurant space as well, or are those primarily the ones that you have talked about and that you still are?
Those primarily, but we're keeping an eye very closely on the whole space. Leave it at that.
And even in the prospects of what we're currently dealing with, that some of these businesses that have drive-throughs could obviously see a tick up in business, or at least try to toe the line until the other side.
Yeah, again, we're looking at situations. We're trying to normalize the business, so we will write off the first quarter and second quarter, and really see what the business looks like going forward. Now with restaurants, what you have to understand is some of their franchisees may not make it, and I think that's why you have to be very careful with those. The other related group, and you and I have talked about it before, I think the gig economy companies are going to come out of this harmed, not enhanced. I know there's a body of thought that, everybody will just do food delivery and we'll all take Ubers and no one's going to buy a car again. And I think that the flip side of it is that the labor pool issue for the gig economy companies is going to loom very, very large coming out of this crisis. Keep in mind that we as taxpayers are paying, correctly so, the unemployment benefits for a lot of drivers, Uber, Lyft, Grubhub, and so on. And but the reason we're paying that is because the companies themselves never paid into the unemployment pools. It's the whole idea of keeping employees as independent contractors rather than employees. And I think both political parties are going to be looking at that pretty hard coming out of the crisis to enhance corporate responsibility in lots of different ways, whether it's keeping employees as independent contractors, whether it's restricting buybacks. There's lots of issues yet we haven't thought through about this that I think will make a difference to U.S. businesses.
Well, I want to get it specifically into the Ubers and the Grubhubs and things that you have mentioned before. You did mention Josh's name, and I want to bring him in. Jim, I'm sure he has a question for you as well. Hey, Josh, you there?
Yes, of course. Hey, Jim. Greetings from the South Shore of Long Island, my friend.
My second favorite place in the whole world, Josh. You know that.
I do. I wanted to just bring up, because I don't know if all the viewers are aware of this, but you've actually taught a class on financial fraud at an Ivy League university, and philosophically, there's a silver lining about recessions and bear markets in that this is the only way we ever really discover fraudulent operators, whether on Wall Street or at quote-unquote blue-chip companies. And every market crash, the second wave that happens after the initial shock that stocks went down, is that we realize that a lot of magicians were really just behind the curtain and not actually performing magic. Right. And you played a big role in exposing Enron after the dot-com crash. You recommended a book to me, The Match King, about the unraveling of a giant multinational corporation in the Depression. And of course, Madoff was unmasked by 2008. What happens is people that thought they had returns, the returns were phantom, and when they went to get their money all at once, there just wasn't enough money to give back to people. So my question is, first, I'm sure you consider that to be a positive because these schemes and scandals can't continue to run on forever, and this is when they stop. But the second part of that is, what areas of the economy or the stock market do you think, without mentioning anyone's name specifically, but where do you think the next big scandal will emanate from? What kind of work are you guys doing on that question?
Yep. All right. Thanks. That's a great question. In fact, I'm teaching my class remotely, and this upcoming Monday's case is Ivar Kruger and the Match King, and my good friend Frank Partnoy is going to be guest lecturing at the class. And you hit on one of the themes of the class, which is that the fraud cycle follows the business and financial cycle with a lag. As the longer an economic expansion goes on and the longer bull market goes on, people's sense of disbelief is reduced. And they begin to believe more things that are too good to be true. And inevitably, when the cycle turns down and people get stingier with their capital, since most frauds today are by and large sort of Ponzi schemes or Ponzi schemes kind of once or twice removed, it gets harder to keep the game going because cheap capital is not available, and the business models collapse. And then we see the wrongdoing. And I've always joked that the best defense attorney and the best prosecutor for a company is its stock price. People don't get upset when they're making money on the upside. They look the other way on bad corporate behavior. The short sellers, the journalists, the naysayers will be pointing out that a guy's doing this, he's doing that, he's obviously lying, and people will shrug and go, so what? The stock's going up. But when people start losing money, boy, do they get upset and press politically legislators, law enforcement, regulators to crack down. We saw that after the dot-com wave, right, with Enron and Sarbanes-Oxley. So where are the excesses today, and where might the gray area cross the bright line? And I think two areas are really areas to watch out for. The first is the fraud. I think the fraud that's hiding in plain sight, which is the aggressive and over-aggressive use of metrics rather than GAAP earnings. And we see it particularly in the lavish use of share-based compensation in Silicon Valley, but everywhere, where people simply are paying employees with stock and adding it back to pro forma earnings. Any way you cut it, compensation is an expense. It should be expense, whether paid in stock or cash. And then I could go on with all the adjustments to EBITDA in the private equity space, and we don't have time to get into all that. But a lot of the aggressive and maybe overly aggressive behavior is staring you in the face in this cycle, and a lot of it on the West Coast. And then if we want to go further west, I think the other area, and we saw it this morning with Luckin, you have to avoid these Chinese companies like the plague. I'm sorry. I mean, I know how many times investors have to be burned in these companies that are just too good to be true, growing at 40, 50% a year, with all kinds of odd transactions with affiliates, variable interest entities based in Cayman Islands.
Hey Jim, I want to just clarify some of that because I think it's an important point. MSCI, as part of their index management, specifically over foreign stocks and emerging market stocks, have given China a greatly upgraded role in the makeup of those indices to the point where investors buying overseas stocks increasingly own more China if they're hugging that benchmark. And let's face it, most are. So that's part one. Part two, the exchanges have somewhat blessed investing in Chinese companies by virtue of the fact that many of them are listed on either the NASDAQ or the New York Stock Exchange. So do you see those two things as being part of the risk here for most investors watching us right now?
Well, I think that those are certainly have contributed to investors' either love affair or overweight in China, and as well as the idea that, now listen, I've been known a little bit as a glass half empty guy in China, to be fair, but the secular growth rate that China reports is awfully attractive to people. If the economy is really growing 6% a year and the rest of the world is struggling, why wouldn't I be looking there for secular growth stories? The problem is that an awful lot of those secular growth stories are manufactured literally for Western investors, and that's the problem. And so we had been as light in China, if you remember, about a year ago when you guys were talking to me, we were as low to the ground in China as we've been in years. We've been increasing our Chinese exposure in our global short funds and global hedge funds because I also see another problem, which is coming out of this crisis. I think U.S.-China relations are really, really have been harmed. And if we had seen some of the activities from China last year that we're seeing now, such as expelling all Western journalists, and really, really things like that, a year ago, I think people would have been running around with their hair on fire. But because it's happened in the backdrop of the virus, we've kind of neglected it. But things are getting much, much worse on the U.S.-China front. And if you think about things about corporate supply chains post-virus and reliance on imported products that are essential to our well-being and national security, I think, and even if you look at the Democratic positions, the Biden positions, and others, I mean, they've hardened as well. And so I suspect that things are going to get worse between the U.S. and China before they get better.
So you're as negative today on China as you were many years ago when you were the loudest voice.
Well, we were one of the only voices. No, we're not as negative as we were in 2010-11. We had about a quarter of our global short funds and hedge funds short China, but we got down as low as 5 last year, and I think we're a little bit over 10 right now.
So let me ask you, you said, one thing that makes it hard to stay short is when a stock gets creamed, like some of the energy ones have done and like Luckin has done today where you've covered it all. The other is when a stock goes parabolic, like Tesla did over the winter.
Who?
Are you still short that, and how did that impact your thinking on your positioning?
So Tesla, and we told clients in January, February, that the 3-month period, sort of November, December, January, was one of the craziest periods I've ever seen in my 40 years on Wall Street. And if you remember, and I know Josh saw some of this stuff, and maybe some of your other panelists, retail for some reason came pouring into the market in individual names and individual stories in a way we haven't seen really since sort of January, February of 2000 at the end of the dot-com boom. And we saw the parabolas, we saw the Teslas, the Virgin Galactics, and others. And we saw it in the data of retail trading at E-Trade and options and Robinhood and so on and so forth. And I had not seen, that was the one thing that had been missing in this bull market in the 10 years, was just manic speculation by individuals. Well, sure enough, by January, February, we had it. And, we saw these stocks go parabolic. And if you're parabolic and you're short, obviously your position's getting much bigger. So in situations like that, if we like the name, like we like Tesla, we will have to cover some if it goes through our risk parameters, but then we will sell it even back down if we want to keep a maximum position. Again, one of the challenges of the short side is that you get bigger when it goes against you, and you get smaller when it goes your way. We are still basically maximum short Tesla. It's still one of my favorite positions. Nothing's changed in my viewpoint here. This is a car company. It will lose money again this year. What I find fascinating about Tesla is that the 2021 estimates, which track the stock on the way up, are now being cut dramatically. I think Tony Sacconaghi, who you know, cut his 2021 adjusted EPS number yesterday from $18 to $11. I mean, that's not affected by the virus. So, I mean, we're seeing big number cuts in this company. They're building 2 plants. They finished China. They're building Berlin. They are increasing capacity, I think, exactly at the wrong time. And if you know anything about manufacturing economics, you know that units, you also need to cover your overhead if you're building more and more capacity. And if you're not producing at 90+% of capacity, you're basically not going to be profitable.
But from a risk standpoint, you did cover some of the Tesla short when your position got larger because the stock had gone parabolic, as we said?
Yeah, we have a 5% limit on our funds. So if anything goes through 5%, we have to cover. But on the other hand, we will add on the way down if we still like the position. And it was a very instructive story, and that was a company called Valiant Pharmaceuticals that went from 130 to 260 on us, and we had to start covering stock at 180 and 200 on the way up. But then we sold it all the way down.
Do you think, though, the fundamentals of the balance sheet of the cash position have improved? You would admit that, though, correct?
Oh, yeah. It's not an insolvency story, at least not here and not yet. But it's also got a market cap, that's $89 billion and an over $100 billion total enterprise value. This is a company that hasn't made any money since its inception, and is not going to make any money this year, and is not going to have 1 million robo-taxis as it promised this year. And so it's a car company. It seems so simple to point that out to people, but you have to keep doing it. Car companies did trade at 1/2 of revenues. Now they trade at about 0.25 of revenues. And of course, Tesla is trading at 4 times revenues. So the risk reward is I think, somewhat self-evident.
I'm reminded of the Charlie Munger quote from months ago on this. I want to remind our viewers of it, and I know you know of it, but remind you as well and have you react to it, of Tesla. I would never buy it. I would never sell it short. I think Elon Musk is peculiar, and he may overestimate himself, but he may not be wrong all of the time. Is he onto something there about Musk himself and just the nature of the way that this stock trades? It's tough to be a player.
Well, I think that we talked a little bit earlier about my fraud course, and there's a wonderful model we use by a woman named Marianne Jennings, who wrote a great book, The 7 Signs of Ethical Collapse, and it's a checklist of all of the great frauds in history, and it's a seven-point checklist of attributes that all the great frauds have had in history. And all I'll say is that Tesla, I think, checks 6 or 7 of the boxes. And to Mr. Munger's comment, I don't know what that statement really says. I think that statement actually describes kind of almost everybody, right?
It's just this has been such you could theoretically be right about some, most, maybe all of the things you say. And yet the stock can work against you regardless, right? There are certain things that are a cult type stock. You know where I'm going when I bring up that. So regardless of the argument you make as to whether it is prudent, relevant, or fundamentally sound, it may not matter by the way that the market trades something, whether it's Tesla or something else. This just happens to be the example that we're using and to what Mr. Munger was speaking to. Well,
they're cult stocks until they aren't, Scott. And again, I think that when you price in the cult at basically 16 times where the rest of the industry is trading, it had better stay a cult stock because there's no margin for error here. And I think that's the opportunity if you're a skeptic.
Jim, you know Rob Sechin. He's with us today, and he has a question for you, too. Rob?
Hey, Rob.
Hey, Jim. Great to have you on the show. I feel short selling plays a vital role in market function and keeping management honest, and you're one of the best at it. So thanks for being on. I have a couple questions for you.
Sure.
Do you think investors, 3 questions actually, are looking beyond like you are to 2021? Has that migration begun? That's number one. Number two, given the induced coma that we've kind of put the economy into, are you surprised at how well markets have held up? And does that have something to do with cash on the sidelines? Yeah. And, is this ultimately going to be the death of passive investing and the indexification of markets? What are your thoughts on those topics?
I'll pass on the last one. I don't know. I'm generally a fan of passive investing. I sit on investment committees and allocate capital, as well as run my hedge fund. And I'm often the one advocating a big slug of passivity, because for most investors it makes sense. And so I'll sort of punt on that one. A couple of constructs, and again, with the overall view that I really don't know specifically where the market's going. But if you want to think in terms of frameworks, I don't think the market is screamingly cheap here. It's down a lot. But on the other hand, again, we can ignore 2020. But if you look at the S&P, I think last year was about $160 in earnings, give or take. And as we got before the virus hit, I think people were they were bringing their numbers down for 2021 to somewhere around that same number. But that's at a 21% tax rate. And I pointed out to people, in the not small chance that the Democrats take the White House and the Senate, and I know the Senate's much more of a toss-up right now, but if corporate tax rates were to go back to 35%, that $160 is $130. And so the S&P is kind of, all right, it's not 10 times, which is where a lot of bear markets bottom out at 10 times or less. In 2009, it was 8 times the previous peak's earnings. In 2007, earnings peaked out, I think, about $100 per S&P share, and I think the S&P got down to about 600, 650, 700. And that's been also the case in 2002 and go back to 1990. So they're not giving things away here, but they're certainly not as expensive as they were a month and a half ago.
Were you guys, when the market did get hit, pretty severely, obviously 10 days ago or so, yep. Were you buyers for in the hedge fund on the long side, thinking that the market had gone down too far too fast?
This 2 weeks ago, when I think about the 19th or the 18th or somewhere around there where it bottomed out, I think I'd have to go double check, but I think we were probably net buyers. Yeah, I'm virtually certain of it. Just because lots of things got down to prices that where the risk reward for what we do is just not there anymore. But then a lot of things snapped back dramatically. I mean, we had some stocks up 100% in the following 7-8 days.
How do you view things like the airlines here or hotels, things that have obviously gotten hit from a stock standpoint and who are going to be facing a lot of trouble going forward?
Yeah, we weren't in the cruise lines or the airlines. We as we're in the casinos, and I just think those are such troubled business models, and you're really going to have to figure out, as I indicated at the beginning of the show, what do these business models look like coming out of this, right? They're disasters this year. We know that. But, airlines, I can give you a pretty educated guess. Airlines are still going to be around. I don't particularly think they're great businesses, but they're going to be around. So you can look in the capital structure and see maybe there's something interesting to do. Cruise lines, I don't get it. I haven't gotten it all along. They're non-U.S. taxpayers. They're flags of convenience companies. They wanted U.S. taxpayer assistance, which was patently absurd in my view. And I think that business is probably permanently harmed. So it just depends. I mean, and what are we going to do as a society? Is this going to be like 9/11, where our lives changed, right? We gave up small personal freedoms when we traveled or whatever because of security issues. Are we going to congregate as much coming out of this? Are there going to be costs for companies that are involved in dealing with the mass public, that whether it's higher insurance costs, higher health-related costs, whatever it might be? I mean, I think investors have to really kind of put sharp pencils to this when they look at business models coming out of the virus to figure out, are my companies going to be permanently changed, or is this purely temporary?
Let me talk more about sort of on the theme of coming out of this, because another company that you've been short is Uber. And Dara Khosrowshahi, the CEO, commented a couple of weeks ago about this very thing. I'm going to read the quote, and we can get your reaction on the other side of it. Our balance sheet is incredibly strong, he said. We have plenty of liquidity on the books, which we think positions us to come out of this crisis, and we will come out of this crisis strong, capable, and important. Now, their bookings are obviously down because of the virus. That's no surprise. But the fact of what he is saying about the other side, do you disagree with him?
I do disagree on one major point, and one of the reasons we're still short all of the gig economy type companies is that I think that their entire business model is based on this labor arbitrage. That basically their employees, their drivers, in effect, are not employees. And that is huge, because keep in mind that right now the cost to keep an employee beyond salary is usually 20% of someone's revenues in the form of payroll taxes, unemployment pool taxes, and a variety of other taxes for employers. And usually the employee pays about half of that. In the case of the gig economy, the employee is paying all of that. And so it's why a lot of these drivers realize they're not making much more, or if not even less, than minimum wage when they factor in all of their additional expenses. And that's why these businesses exist. I mean, the taxi cab business has been around a long, long time. And so I think that if you're a gig economy investor, you have to at least consider the possibility that the entire labor relations aspect of this business model is going to change. And I think that's really important.
And if it does change, as you say, it might. And, I've seen some politicians in Washington over the last couple of days bringing up this very issue related to the virus and what happens afterwards. And the people who are struggling right now, who were driving Ubers, whether it was part-time or even full-time, who are now doing it no time. Yeah. You think that's a net negative, even if that changes the way the company operates after this?
Well, I mean, obviously, I think they're going to have the company's going to have higher payroll-related expenses. And so the question will be then, investors, will they be able to charge consumers more if they do that? And that remains to be seen. But, it's a fundamentally unprofitable business model. And even when Uber says, well, we're going to be adjusted EBITDA positive, I think he said fourth quarter of 2020, not 2021. People got excited. I kept pointing out to people, that's before share-based compensation, which is running almost $500 million a year. And so are they really profitable if they're not counting that? And so this is the problem. If you look at Grubhub, I mean, just look what they did recently. If you want to talk about bad actors, they did this promotion. They promoted a promotion with their restaurants where they urged the restaurants to offer big discounts and deliver through Grubhub. And then in the fine print, they told the restaurants that they, of course, would not take cuts in their cut. And so this is somewhat of an almost predatory business model. And for the food delivery guys, I mean, I think they've got an even more existential issue, which is I just think a lot of the independent restaurants, which is where they make their money, they don't make money in the McDonald's of the world and the Burger Kings.
You're still short Grub?
Still one of my favorite positions. And I think that structurally they just don't make money. And here's your tell on Grubhub. If Grubhub doesn't make any money in the first half of 2020, I would argue they're probably never going to make money.
They did give us a statement, by the way, because what you do say about this so-called Supper for Support program that the company was running is in fact true. The price of the discount that Grub was saying falls on the shoulders of the restaurants, not Grubhub paying the discount, as it were. They say, and I'm just going to read this for our viewers, they say since it launched, participants have seen 30% more orders on average. And so because it is working well for those restaurants, Grubhub is doubling down on the promotion and encouraging more signups by giving $250 to each participating restaurant. Based on the results so far, we anticipate this funding from Grubhub will help generate at least $100 million in restaurant sales and cost to Grubhub of approximately $30 million. We did ask them for a statement about this program, and that's how they did respond, Jim.
Yep, well, they were caught out in it, and I don't think that when they made that announcement originally they had that program. So I think they've gotten lambasted on social media and the press and by restaurants for doing that when they rolled it out. So good for them if they're going to try to give that back. But it still gets to my problem, which is I just don't think this is a profitable business. And where they are getting higher delivery through the fast food outlets, Grubhub themselves said they don't make any money in that business, delivering burgers.
Is there a way, though? I'm just wondering, sort of on the other side. Forgive me for interrupting you. I'm wondering on the other side of this, if the world does change to some respects. And I think we all think that in some ways it will. What if, look, there was a talk about a possible deal for this company months ago, which, to some may have sounded outlandish in the suggestion of, well, who would potentially buy them? But if you look down the road and you do see the world and habits changing in some way, is a company like this more attractive to a bigger player because people will, in fact, want delivered food more often than going into a restaurant, and restaurants may be half the size in some cases on the other side? Here's
the conundrum with that question, Scott. If you don't make any money delivering for the big chains, which is where a lot of the volume is, and you're only making money delivering for an independent restaurant, and independent restaurants survive this, coming out of this, why will independent restaurants ultimately not do this themselves and just pay an agency fee? Why do they need to give up 20% of the take to a third party? This has been profitless prosperity for the restaurants in good times, and so it doesn't scale. Delivery guys can only do 2 deliveries an hour. It's not like other Silicon Valley network effect companies. It's literally a body shop. You have to have more drivers to do deliveries, and that's the inherent problem why this is never going to be profitable.
Let me. I'm sorry. No, I was going to say I wanted to bring in another one of our panelists to get a question in. We're running through time so fast, as often happens in these interviews. Jenny Harrington, do you have a question for Jim?
Sure. Thanks, Jim. I'd love to circle back to one of your earlier comments where you said you took your shorts in energy off in the beginning of the week. If you took your shorts off, it would presume that you expect there to be upside from here. So I was curious if you're exploring any purchases in the energy space and if there's any theme around that, either company specific or micro industry, where you're actually finding value and think that there could be upside.
Yeah, I mean, I've not been a fan, as Scott knows, for a long time. I would tell your viewers, avoid the frackers. That's a simple blanket statement, long or short. Just avoid them. They incinerate capital. It's not a business. It's a scheme. More money has gone into the ground than has come out. And so we've been negative on that space since 2014. We remain negative. It's difficult because right now it's such a play on the commodity price, even for the integrateds. And I haven't done any work recently on the pipeline, so I'll avoid that. I know some value people are nosing around that sector, but even the integrateds, who just had just ironclad balance sheets. Remember when Exxon had an ironclad balance sheet? It doesn't anymore. And nor do the other majors who paid big dividends and generally were pretty conservative holdings for investors. So it's a tough area. I think it's going to get tougher. Balance sheets have deteriorated, not gotten better. And then you have this whole problem where the fracking business model isn't really just a business model. It's an accounting scam. They never depreciated the wells fast enough. And so, by and large, the stocks had come down so much, the risk-reward was kind of gone on the short side and better elsewhere. But I'm not a big fan of the industry.
Jim Lebenthal, you have something for Jim?
Yeah, if I can just start off by saying, as a long equity manager, I have a lot of respect for short sellers. I know that's not only what you do, Mr. Chanos, but it helps in price discovery. It's real money that you have at risk. And when I'm entering a position, if I believe in the position, one of the metrics I look at is what's the short interest? Because as you pointed out, you have to cover at some point in time. So if there's no accounting fraud, short interest can be very helpful. But my question to you is, we're living in this world where every day something's coming out of the federal government, whether it gets enacted or not. Yeah. And as an example, one of the things that's being talked about is maybe we get an infrastructure bill. That wasn't really talked about a week ago. The question is, you have real money at risk on the short side, and losses can be infinite if things go awry. Are you in any way overly worried about any given morning there could be something coming out of the federal government that dramatically changes your investment thesis on the short side, and what do you do about that?
Well, again, we're in our hedge fund, we're net long, as I indicated, and in our short programs, for the most part, we are compensated on how we do relative to the market. So I've always joked I'm in the insurance business. I don't think I'm short any companies right now that would be directly benefited by an infrastructure bill. And as for government involvement affecting the stock market, at this point in my career, I'm pretty much resigned to the fact that there's always going to be government involvement in the financial markets. It seems to be getting worse, not better, as it relates to the government deciding to spend taxpayer money to support various different industries. Now, an infrastructure bill is probably overdue. It should have been done a long time ago, given where rates are. But we always worry about that kind of stuff, and the government is increasingly of the belief that it needs to rescue various industries. I would point out, to go back to the airlines, on Monday, I pointed out to clients that the airlines, the 4 or 5 largest publicly traded airlines in the United States had a $50 billion total market capitalization in equity. Why are we talking about equity grants? If Carnival Cruise Line can raise money in the debt and bond market and equity markets, why aren't American Airlines, United Airlines, and so on raising equity in the stock market? Why does this taxpayer need to do that? And that's just a philosophical issue I have, which I think we probably don't need to get into. But yeah, Jim, I mean, we always worry about that stuff, and we're always, can the government do something in an area that we're negative on that would affect valuation and perception? Sure.
You're obviously not the only one, Jim, who is looking at the current landscape of bailouts and rescue plans and taking issue with certain parts of them, obviously. Josh Brown, I know you wanted to get in earlier, and we are running out of time. What do you have?
Well, real quick, I think the answer to why the airlines aren't in the debt markets right now might have to do with something they're discussing with Omaha, but we'll find out. I want to push back on Uber. I'm long the stock. I don't disagree with everything that you've said, but here are 3 things the bulls would say back to you. The first is, unfortunately, the pool of available labor for Uber drivers is now substantially bigger, given the unemployment numbers that we've seen in the last 2 weeks. 2, mass transit might be more at risk than Uber coming out of this. How many people are now thinking about, well, how am I going to get to work from now on if I no longer want to be on a commuter train, a subway, or a bus? So they might actually benefit at the margins for middle class, upper middle class commuters. And then the third thing is, I'm not so sure that there will be the political will to change the employment structure for companies like this. And one example of that is they're now including self-employed people in the unemployment insurance package that's coming from Treasury, sole props. They're going to treat them as though a company laid them off. So it almost seems like they're being entrenched What would you say to those 3 points that a bull might make on Uber specifically? And I own the stock, by the way.
Okay. Well, so in reverse order, I think that you're actually making my point. I think that employers will be put into those pools. That is, I think that because we are covering these drivers and self-employed people, as I think we should, I think that
right.
that employers should be paying half those costs as CNBC pays half of Scott's and Kynikos pays half of mine, and that the employee should shoulder the same amount, whether he's an independent, quote-unquote independent contractor or not. So I think that the cost of doing business from a payroll point of view from the Ubers and Grubhubs of the world is going to go up. Now, skipping to the first part of your question, will the available number of employees increase? Well, if unemployment becomes structural, possibly. But if unemployment becomes structural, I'll cede that point to you, Josh, and figure out that a lot of my other companies are going to have much bigger problems. I'm assuming that the unemployment will not be structural, and that we will get a bounce back, and therefore labor rates are going to stay the same or maybe even rise. And so I think that the unbridled capitalism, where everybody's going to fight for these minimum wage jobs, I think could in fact see additional regulation, not only on the payroll tax side, but in restrictive minimum wage and other things. So I think we just disagree on that front. As to the second point, I think that's the interesting one. I've heard both sides of saying that I'm never going to take mass transit because it's just it's too many people and too confined to space. And then I've heard I don't want to get in someone's car. I don't know who's driving me. I don't know what whether they cleaned the vehicle, who's been in it before. I'm definitely less than 6 feet in that vehicle. And so I don't know. We'll have to see how that plays out. The problem, again, in this industry, though, is at the micro level. It's not economic. That these are body shops, quite literally.
Let me. I only have a couple minutes left, Jimmy.
Yep.
I want to ask you one more question about a stock, if you will, that you're very long. Ticker symbol is Joe B, as in Joe Biden. How is this all going to impact? How is the virus going to impact his ability to campaign? We already know, literally, we came on the air today. The convention announcement had come out that it's being pushed back. How is that all going to impact him? What are your thoughts? Have you spoken with him recently?
I've not spoken with the vice president very recently, but I've certainly spoken with his team and have been in touch with the campaign almost every day. As you know, I'm close to the vice president. I think stepping back before I talk specifics there, and I don't know a whole lot more than what the public knows, I would say that I think the political dynamic will change. And I suspect as the virus subsides and or vanishes, hopefully, I think that the discourse is going to get a lot sharper and the elbows are going to get a lot sharper. And sadly, they've already been pretty sharp, as we know, right? But I suspect when fear turns to anger, you're going to see a different dynamic in a lot of races around the country. And that's why I'm kind of keeping my eye on the Senate races as well. Look, the convention, I'm a Milwaukee native. I was looking forward to the convention this summer and hitting up a few Brewers games and eating some brats, but we'll see what happens there. I think that there will be a stark dichotomy between the two candidates and the two parties, probably more than ever coming out of this in the fall. I don't think the markets are focused on that right now. I don't think the markets are focused on the healthcare debate, which I think will kick back in, in terms of our healthcare economy and what should be provided and what shouldn't. I suspect the virus might even blur the lines between the parties on some of these issues, on things like employment and healthcare. And so it's going to be I think it's going to be kind of a wild and woolly fall. And we'll see what happens. I think the vice president has correctly been been mindful of where we are and is not trying to make big political points on it. I think that's the right strategy. But I also think that the administration will be held to account when the time comes. And so I suspect the political rhetoric's going to heat up post-summer. That's about the best I could say. And
understand. I really appreciate you being with us today. It's been a while, and it's always an interesting conversation, discussion, and debate. Jim, thank you so much.
I'm so happy that you invited me on. Guys, stay safe, everybody. Josh, we got to do a steak soon.
Mm-hmm. You as well. Jim, you be well, stay safe, and stay healthy for certain. That's Jim Chanos, the Kynikos Associates founder.